let me ask you a question. A company's profits shoot up almost 800% in just 2 years, right before they ask you for your money in an IPO. So, is this a rocket ship you absolutely have to get on? Or is it a giant red flag waving in your face? That's the big question we're digging into today. Today, we're doing a brutally honest, no-hype breakdown of the Armour Security IPO. Here's how we're going to do it. First, we'll look at what the company actually does. Then, we'll cover the good stuff, the investment positives. After that, the major red flags you can't ignore. We'll crunch the financial numbers and finally land on a verdict for you as an investor. Let's get right to it. Okay, first things first. Before we even think about investing, we have to understand the business from the ground up. What are they selling and who are their customers? So forget about flashy tech or some disruptive new app. Armour Security is in the very traditional, boots-on-the-ground business of providing people. We're talking security guards, housekeeping staff, and general facility management crews. It's a fundamental business-to-business service. So their model is about as straightforward as it gets. They sign contracts with other companies to supply them with workers. Now, this kind of model can definitely scale up, but, and this is important, they admit right in their own IPO documents that they're in a highly fragmented and super competitive market. What does that really mean? It means they're constantly fighting a ton of other companies for the same contracts, which almost always puts a cap on their pricing power. And this is pretty interesting. This chart shows us where their money is actually coming from. Even though the company is named Armour Security, a little over half of their revenue, almost 54%, comes from what's called integrated facility management. Think housekeeping, general building upkeep, that sort of thing. The other 46% comes from the security and manpower services you'd expect. All right, let's switch gears and look at the bull case. This is the story the company really wants investors to see. And to be fair, there are a few points here that definitely catch your eye. On the surface, the story looks pretty solid. First, and this is a big green flag, the IPO is a 100% fresh issue. That means none of the existing owners are selling their shares and cashing out. All the money you put in is supposed to go right back into the company to grow the business. Plus, the promoters have been in this industry for over 20 years, so you'd assume they know what they're doing. And here it is. This is the headline number that's getting all the attention. A nearly 800% explosion in profit after tax. We're talking going from just 29 lakh rupees to over 261 lakhs in only 2 years. Now, that's the kind of hockey stick growth that gets investors really excited. But as analysts, it also makes us ask a very serious question. Is this for real, and can it last? You know, that incredible growth is the perfect entry point to the other side of this story. It is time for a major reality check, because hiding under those shiny growth numbers are some pretty serious risks that you, as an investor, absolutely have to know about. This right here is probably the most important question you can ask before putting your hard-earned money into any company, especially an IPO. What are the potential deal breakers that aren't immediately obvious? And here is red flag number 1, and it is a big one. This isn't just a small risk. This points to a really fragile business. As of last September, almost 80% of their entire business came from just 10 customers. Get this, 2/3 of their revenue came from only 5. That is a massive, massive dependency. If they lose just 1 or 2 of those big contracts, it wouldn't just be a bad quarter. It could literally cripple the company's finances overnight. Okay, now for what is arguably the biggest red flag of them all. Right in their own prospectus, it says that one of the key promoters, Mr. Vinod Gupta, runs a totally separate private company that is in the exact same business. This is a textbook conflict of interest. It's a huge corporate governance problem. Think about it. As a public shareholder, what guarantee do you have that the best, most profitable contracts won't just get steered over to his private company? None. All right, so with the positives and those pretty serious negatives on the table, let's really dig into the financials. Do the numbers back up the amazing growth story, or do they actually highlight the risks we just talked about? So take a look at the profit after tax line here. See that jump between 2022 and 2023? It's an 8-fold increase. But now look at the revenue line for the same period. It only went up by about 7%. So how on earth does that happen? How does your profit grow 8 times faster than your sales? That's the mystery we need to solve. And this slide right here is the answer. The company got way more efficient. In a business like this, your single biggest cost is salaries, paying your people. In 2022, employee costs ate up almost 94% of every rupee they earned, leaving practically nothing for profit. But by 2024, they managed to get that number down to 80%. That improvement, that efficiency gain, went straight to the bottom line, and it's what took their profit margin from a razor-thin 1% to almost 8%. So this is the core dilemma for any investor looking at this. On one hand, you have this absolutely incredible profit growth and some real efficiency gains. But on the other hand, you have this extreme client risk and a massive governance red flag. So how do you weigh these against each other to make a smart decision?
Let's just break this down very simply by investor type. If you're a safe, conservative investor looking to protect your capital, this is a clear avoid. The risks are just way too high. If you're a moderate investor, you need to approach this with extreme caution. Honestly, only if you're an aggressive, high-risk investor, someone who fully understands that this could swing wildly up or down, should this IPO even be on your radar.
So to put it as plainly as possible, our final verdict is this: neutral, and strictly for high-risk takers only. This is not a broad-based buy recommendation in any way, shape, or form. Look, at the end of the day, it all comes down to this. Are you willing to place a bet that this company can successfully find more clients and that the promoters will always act in your best interest as a shareholder? That incredible profit growth is tempting, no doubt about it. But the fundamental fragility of the business and the serious governance questions are just too big for the average investor to ignore. This is a speculative bet, not a solid foundational investment.